The broadcast is now starting. All attendees are in listen-only mode.
Hello, and welcome to today's webinar covering the latest market trends and issues in the ports and terminal sector. I'm Leticia Astudillo, and I'm joined today by Eleanor Hadland and Eirik Hooper from our ports and terminal research team. It will take about 20 minutes to go through the slides, after which there will be a Q&A session. If you would like to ask a question, please do so via the questions panel on the screen. You can do this at any point during the webinar, and we will endeavor to answer as many questions as we can at the end. However, to preempt the most commonly asked question, yes, we will be sending out a recording of the presentation and a copy of the slides. I will now pass over to Eirik to start the presentation.
Thanks, Leticia, and good afternoon to you all, or good morning, depending on where you are. Thank you for joining today. So the agenda for today's presentation provides selected highlights from our recently published Ports and Terminals Insight Report. We'll deal with the deals and developments, then move on to the ports that remain under pressure to upgrade for the upsizing fleet. We'll look at the Global Ports Monitor. We'll look at financial performance of the port sector, and on to conclusions of the Q&A. In the deals and development section, we will also provide a brief commentary on the news that's catapulted the container terminal industry into the headlines recently, since it was announced on the 4th of March that a BlackRock TIL consortium was acquiring the majority of Hutchison's container terminal portfolio, including the two ports on either side of the Panama Canal. The principal source of material for this webinar is the Ports and Terminals Insight Report, which was published in February. This is available via the website as an annual subscription, which includes a quarterly report and a monthly data supplement. This monthly supplement provides timely insight into global and regional port performance trends, drawing extensively on Drewry's proprietary AIS-driven analytics model, which covers more than 190 of the world's top ports. Some of the analysis of the Hutchison MSC deal also used data contained in Drewry's Global Container Terminal Operators Annual Review and Forecast, which was published in July 2024. Let's make a start by taking a look at some of the big deals and developments in the container terminal market over the past few months. The last two editions of the Ports and Terminals Insight Report have highlighted the relative success of hybrid operators, notably CMA, CGM and MSC, in securing new concessions and/or engaging in M&A activity in order to gain access to new markets and to grow the reach of their portfolios. MSC in particular has been incredibly active, with 6 deals announced between November 2024 and February 2025, not including the latest mega deal. In the Insight reports, we picked 3 of these to explore how they fit into MSC's overall market strategy. So in November 2024, MSC announced its entrance into the Mexican market with the acquisition of IPM Terminal in Altamira from Grupo Pinfra, a leading Mexican infrastructure company. Mexico has been growing in importance in the container shipping world for some years now, with growth in container handling in 2024 of over 12% to a new height of over 9 million TEU. While this terminal is not a huge deal on its own, handling only 230,000 TEUs in 2023, when it's added to Hutchison's portfolio in Mexico, it gives MSC terminal capacity in each of Mexico's 5 largest container ports in one of the fastest growing markets in the world. Moving further east, just 3 weeks ago, MSC announced it was partnering with Marsa Maroc, the Moroccan national port operator, in its Nador West Med port development, which is planned as a Tangier-Med substitute some 250 km further east of the West Med transshipment hub. MSC is already a major player in the West Med market, including a minority stake in the 1.6 million TEU Eurogate Tangier terminal in Tangier-Med and a wholly owned 1.6 million TEU terminal in Valencia in Spain, where it's also the concessionaire for a 4.8 million TEU CT4 development, whose first phase is anticipated to open in 2029. We also went on to highlight the MSC Samudera Toyota consortium win for a 37-year concession to develop and operate the container terminal at the port of Patimban in Indonesia. This new port is developed in the heart of West Java's manufacturing belt, about 70 kilometers from the Karawang industrial estate and 145 kilometers from the capital Jakarta and its severely congested Tanjung Priok port. Now, MSC's position in Southeast Asia has until now been limited to a JV with PSA in Singapore. After this concession win and the Hutchison deal, their portfolio will go on to include 3 terminals in Java, including 2 in Tanjung Priok, as well as ports in Malaysia, Thailand, Vietnam, and Myanmar. Now we move on to the latest and most newsworthy deal, the largest acquisition ever in the container terminal industry. MSC already had one of the largest and most geographically diversified container terminal portfolios, with 69 terminals and 10 new developments in 47 countries, and that doesn't even include the deals outlined in the previous slide. It was the fastest growing terminal operator in 2023, primarily due to its acquisition of Bolloré Africa Logistics, since renamed Africa Global Logistics, or AGL. With that acquisition, MSC's portfolio capacity increased by 12% year on year to reach 107.7 million TEU in 2023. If and when this new deal goes through, it's going to make that look like very small fry indeed. So what do we know about the deal so far? A consortium of BlackRock, the world's largest money manager with over $12 trillion in assets under management, and TIL, in which BlackRock itself holds a 20% stake from its acquisition of Global Infrastructure Partners in 2024, has agreed to acquire CK Hutchison's 80% stake in Hutchison Ports, excluding any ports in China and Hong Kong. So this deal will add 43 terminals in 23 countries to MSC's already impressive portfolio. Hutchison's portfolio is actually highly complementary to MSC's, bringing strength in regions where MSC's position was weaker or non-existent, including Mexico and Central America, the Middle East, Southeast Asia, and Australia. As with any deal of this magnitude, there are going to be areas of overlap between the two portfolios, and it's likely that competition authorities in certain key locations will want to scrutinise the deal. In particular, we note that there is a risk of market concentration in the Netherlands, where the combination of portfolios would give MSC majority stakes in over 13 million TEU capacity in the port, not to mention significant exposure to Le Havre, Antwerp, Bremerhaven, and Hamburg. There'll also be a review of the much talked about Panama Canal ports, ostensibly the prime mover in bringing the parties to an agreement. Hutchison brings 2 ports, the Colón Cristobal port on the Gulf side of the canal and the Balboa port on the Pacific side. The Panama Maritime Authority is unlikely to overlook MSC's minority stake in PSA's Rodman port, also on the Pacific side of the canal, giving MSC a presence in 3 of the 5 ports at either end of the isthmus. Another potential area for concern is Spain, where the authorities will consider whether Hutch's best terminal in Barcelona addresses the same market as MSC's terminal in Valencia and their €1 billion development project there. So what does this mean for MSC's ranking amongst the largest GTOs? Eleanor, can we go to the next slide?
Yes.
So the bar chart shows how MSC's terminal capacity, given its extensive pipeline of new developments and expansion projects, was expected to largely catch up with the big 3 GTOs, namely PSA, COSCO, and APM terminals, even before this deal. When the Hutchison portfolio, excluding their China and Hong Kong assets, is added to MSC's, their future capacity is anticipated to jump by more than 100% over the next few years, hitting 220 million TEU by 2028. Just a note that this does not take into account any potential divestments, either forced through competition authorities or for strategic or other commercial reasons. But this would give MSC and its various subsidiaries roughly 15% global market share, compared to PSA in second place with roughly 10%. I'll now hand over to Eleanor, who will summarise the issues reports around the increasing number of very large and ultra-large container vessels, for which MSC has been one of the primary drivers.
Thank you, Eirik. I'll now outline the latest research presented in the first quarter edition of Ports and Terminals Insight, where we looked at the container ship fleet order book and asked ourselves the question of where will all these big ships go? So since January 2019, the size of the global cellular container ship fleet has grown by an average 4.3% annually when measured in terms of vessel numbers, but the capacity has increased by an average 5.8% each year over the same period. The share of the global fleet capacity accounted for by very large container vessels, that's vessels between 12,500 and 18,000 TEU capacity, increased from 18% in January 2019 to 23% in January 2025. And over the same period, ULCVs, that's vessels greater than 18,000 TEU capacity, share increased from 8% to over 14%. When we looked at the order book, this trend is set to accelerate, with 50% of order book capacity accounted for by VLCVs and 23.5% by ULCVs. Using our model, based on our AIS system, which tracks container vessel calls around the world, we've analysed the development of VLCV and ULCV port calls between 2019 and 2024. Now, of course, there's a strong relationship between demand and the number of large container vessel calls, and Chinese ports handle the highest number of these calls. But in our assessment, we identified several key factors driving this relationship. And we see the factors that are important are the level of cargo concentration at key ports in any region, the balance of gateway and transshipment cargo, and the technical capability of the region's ports to handle larger vessels. And this can include the channel and the berth depth, berth length, and crane size. In summary, the fleet order book will put more pressure on a wider range of ports to upgrade infrastructure and equipment to handle larger vessels. One of the markets we looked at in depth was North America. Now, this market bounced back in 2024 with volumes up almost 11% year on year, although this performance has to be seen in the context of a pretty dismal 2023. On the face of it, the North American market is pretty well suited for VLCV and ULCV calls. Cargo is concentrated at a relatively small number of ports, and while there is no transshipment activity as such, a high proportion of goods at the major gateways are moved inland via high-capacity intermodal corridors. What we have identified, though, is that technical capability of North American ports, particularly in the US, will remain a constraint to the deployment of ultra-large vessels into this market. As an example, the maximum berth depth available at the main West Coast gateway port of Los Angeles and Long Beach is 16.8 meters, and the latest crane delivery at APM Terminal's Pier 400 facility was only 23 row outreach units. This compares, what perhaps doesn't compare, to the 20-meter deep berths under construction at Rotterdam and the 26 wide cranes already in operation at UK and other European ports. While there is a channel deepening project planned for Long Beach, it is only scheduled to commence in 2027, and that's 11 years after the draft environmental impact statement was first published. And while this will increase depth and width of harbour access channels, it will only deepen more berths within the port to match the current maximum berth depth of 16.8 meters. In contrast, in Mexico, terminal operators have invested heavily to increase capability, and as a result, we've actually seen a surge in the number of VLCV calls in this area of the North American market. While further investment in upgrading both capacity and capability across the port range is underway, the risk here, though, is that landside transport constraints will hold back growth in the short to medium term. On the East Coast, we see a somewhat different situation. While there was strong growth in large container vessel calls, we identify a number of constraints that will limit ship size. New York's the largest port in the East Coast North American market, and the project to deepen the port's main channel to 55 feet, 16.8 meters, has now entered into its 4-year design stage, and that started in 2024. But the design vessel for this project was just 18,000 TEU. Meanwhile, in the second largest port of Savannah, the maximum size of the vessel that can be received at the port is around 15,000 TEU due to the air draft constraint of the Talmadge Bridge. And while feasibility studies to raise or replace this bridge have been undertaken, most experts consider that it will take at least 10 years for any solution to be implemented. Moving now to look at Latin America, and that's also emerged as a destination for very large container vessels. but ports across these three sub-regions have yet to handle any ultra-large vessels. Callao has emerged as the largest port in the West Coast region, and its terminals are now handling a greater proportion of transshipment cargo following investments by DP World in the South Terminal and APM Terminals TIL in the North Terminal. Now around 30% of the port's throughput is transshipment. Whether the recent opening of Shanghai Port last year will open the West Coast market to ultra-large container vessels really remains to be seen though. While Shanghai offers maximum berth depth of 17.8 metres, which can easily accommodate ultra-large container vessels, it will take some time for the port to become more established in the face of competition from the core port terminal facilities in Callao. Additionally, any ULCVs calling at Shanghai will also need to call at other regional ports, where berth depths range from 13.5 metres in Guayaquil to 16.5 metres in Passoja. When we look at the East Coast market, it's vessel length rather than draft that's the major constraint. This in particular at Santos. Whilst it's the largest port within the region, handling 5.5 million TEU in 2024, that's around a third of regional volumes, it was only upgraded to be able to accept vessels with a maximum length of 366 metres in 2021. Last year, the longest vessels calling at the port, all with LOA of 366 metres, were operated by MSC, ranging from the 13,000 TEU capacity MSC Emma to the 16,000 TEU capacity MSC Marie. But all these vessels are, for other operators, vessels have been at or below the previous 340 metre LOA restriction. Finally, some good news though, if for West Africa. This is a region that's also experienced a surge in large vessel calls from 2023, and the Red Sea crisis strengthened and kick-started this upward trend. There's less cargo concentration in the port range, with the largest port Lomé only accounting for around 15% of total regional port volumes. When characterising the market, we can see a growing gap between the infrastructure and operational performance of modern terminals that are typically operated by global container terminal operators, and a larger number of small to medium-sized ports where there's a greater diversity in the quality of infrastructure and the ownership and management model in place. The rise in trade volumes between Asia and West Africa has also created an opportunity for more in-region transshipment. Whilst traditionally the Moroccan port of Tangier Med has played a key role, this is better positioned to handle European and North American cargo, whilst most Asia-West African services are already routed around the Cape of Good Hope. And as a result, we've seen transshipment hubs including Lomé and Tema emerge within West Africa itself. I'll just now hand back to Eirik for the Global Ports Monitor.
And of course, in the same week, we published the Ports and Terminals Insight Report. MSC announced it would shift its Megamax vessels that are currently trading between Asia and North Europe to the Asia Med and Asia West Africa trades, which shows a level of confidence in both market prospects and port capability in West Africa. So I'll now take a look at the performance of the global container port market in 2024 and provide you with the latest outlook for 2025. So the rolling four-quarter average in global port handling across our sample ports showed a small improvement up to 6.5% in the fourth quarter 2024, which was up from 6.2% in the third quarter 24. The strongest volume performance was recorded in Latin America, where the rolling four-quarter average growth rate rose to 12.4% in the fourth quarter. Brazilian ports demonstrated strong growth in 2024, with annual volumes rising 14.7% in Santos, 25.7% in Paranagua, and 11.5% in Itapoa. North America wasn't far behind, with the rolling four-quarter average growth rate jumping to 11.6% in the fourth quarter 2024, with the strongest growth there registered in the West Coast North America market, where annual volumes rose 15.6%. At the other end of the scale, as a region, the Middle East and South Asia was by far the most underwhelming, showing just 1.9% growth for the year. This was perhaps a predictable outcome from the Red Sea diversions, which were put in place towards the end of 2023 as the Houthis commenced their attacks on commercial shipping in the area. Now, while South Asia generally benefited from the diversions, with annual volumes growing 11.1%, This was at the expense of the Middle East, where volumes slumped by 7.8% annually. Our latest forecast for 2025 port volume growth, which was completed in mid-February, factors in actual port throughput until end November 2024. The forecast for growth in global container port handling in 2025 has remained steady at 3.0%, following the strong showing in 2024. The North American market is projected to continue its recovery, with volumes forecast to be up by almost 8%. Both Europe and the Middle East and South Asia are expected to grow at 4.3% in 2025. Both those are down on previous projections. Similarly, whilst Oceania and North and Southeast Asia are still forecast to show some positive growth in the year, these projections have also been reduced since the last quarter. And the outlook for Greater China has been upgraded, with throughput growth of just 2.0% expected in 2025. So, Eleanor, what does this mean for the financial performance of the port sector?
Thanks, Eirik. Well, in the fourth quarter of 2024, the preliminary results show that the Drewry Global Container Terminal Earnings Index declined 2.2% quarter on quarter, reversing its trend of positive growth over the 6 consecutive preceding quarters. And this was mainly led by a higher rise in unit costs compared to revenue growth. Looking ahead to 2025, we anticipate that earnings will decline as revenue growth per unit is likely to slow, while cost per TEU looks set to rise. Our premise here is that a combination of easing demand for value-added services, especially storage, and higher labour costs, particularly in the US East Coast and US Gulf Coast markets, will start to squeeze margins for major port operators this year. However, much still depends on carrier response to falling freight rates. Blank sailings, as we saw during the pandemic, can generate higher than usual storage revenues, but even so, these are unlikely to rise to the levels seen during that pandemic period. Additionally, since we published, the risk of congestion during 2025 has risen considerably, and this is due to the planned introduction of fees on Chinese vessels at US ports. This we see as probably going to result in streamlining of schedules and greater cargo consolidation, so they'll make fewer calls within the US market, consolidating cargo to a smaller number of ports, and this is likely to cause bottlenecks at the main gateway ports. Anyway, I've seen the time, so time to hand back to Leticia for some questions and answers.
Yeah, thank you, Eleanor and Eirik. I'll now sum up the key takeaways from the presentation before moving on to take some questions, which of course you can still ask using the question panel on your screen. Firstly, it's clear that the hybrid operators, this is terminal operators owned by carriers, are gaining the upper hand in the market, with MSC set to overtake PSA to become the leading global terminal operator as and when this deal is finalized. Secondly, despite the confidence in the market exhibited by Thiel and BlackRock, Drewry flags up that geopolitical and economic risks remain very high, with global trade clearly in the spotlight. And finally, our research into where the carriers will deploy the large numbers of VLCVs and ULCVs that they have on order identified opportunities in some emerging markets, such as West Africa, but highlighted that port capability remains a constraint in other markets, including North America and East Coast South America. So we will now move on to the Q&A. Let me have a look what we have over here. Okay, so we have 10 minutes to answer questions that you have sent to us during the course of the webinar. Feel free to fire across any additional questions, and we will attempt to answer as many as we can in the remaining time. And we will address the remainder via follow-up email in the next day or so. And we will be sending a recording of the presentation and a copy of the slides. I have a question here, I think, for Eirik. BlackRock and Thiel appear to be paying a premium for the Hutchison portfolio. Is it worth it?
Yeah. Well, isn't that the million-dollar question or billion-dollar question? So the announcement detailed an enterprise value of $22.8 billion for the assets, which dwarfs anything we've seen previously in the sector. This implies an EV/EBITDA multiple of 13.6, which is at a premium compared to the industry average of 10 times, which comes from the globally listed port companies under coverage by the Drewry Maritime Financial Research team. But we have to remember that Hutchison was one of the first movers in the industry, building the core of its portfolio during the first wave of terminal privatizations in the 1990s and early 2000s. And it secured a raft of terminals in strong gateway markets such as the Netherlands and the UK, as well as emerging markets in Southeast Asia and Latin America. Then you have to remember that long-term concessions and the huge capital investment requirements for container terminals acts as a barrier of entry to other operators. Because growth rates are now significantly lower than they were 20 years ago, especially in mature markets, that means there were fewer greenfield opportunities on offer as well. We've seen both hybrid GTOs and challenger GTOs using acquisition as a way to break into the market in recent years. You could point to Abu Dhabi Ports' acquisition of Noatum, or MSC with AGL, or Hapag-Lloyd with SAAM Ports, and so on, highlighting that targeted M&A can, in effect, buy market share that would otherwise take decades or more to achieve organically. The BlackRock TL consortium has some quite significant advantages, bringing together the deepest well of capital in the world, one of the largest global terminal operators, which itself is owned by the world's largest container shipping line. So as a consortium, they are in the best possible position to mitigate any financial or commercial risks with respect to any premium paid for the assets. Just one final point worth mentioning: many of the Hutchison terminals or concessions are quite old, and some of the terminals are perhaps underinvested. The funds required to bring them up to standard, especially in the context of the larger vessel sizes that Eleanor highlighted earlier, will be very significant.
Thank you, Eirik. I have one here for Eleanor. Several listeners have raised questions here about tariffs. Eleanor, what can you tell us?
Yeah, well, I've got quite a few questions about tariffs, and I'm wondering what the US government can tell us, because it seems to be different week on week, day on day. We wake up every day to new news on tariffs. But certainly our container forecaster report will be handling this issue in more detail, and the next edition of that will be due out in March. And within this, we're going to look at a number of scenarios about how tariffs may impact demand in different markets, where we may see diversion of cargo to alternative markets if the US no longer becomes that attractive. But it certainly seems that the US consumers will end up paying more for imported goods. Manufacturers that rely upon imported goods for US manufacturing are also going to see costs rise. And now the debate seems to be moving on from the tariffs are certainly going to happen in some shape and format and are starting to be introduced now. To what extent will this lead to inflation, put pressure on the US market, and could this perhaps trigger not just a recession in the US, but also a global recession? So lots of questions there, but because of the uncertainty regarding these policies, and to be quite honest, the flip-flop back of they're in, they're out, they're in, they're out, then we rely on third-party economic forecasts. So we do expect our forecasts to be changing pretty much month on month as the new economic outlook comes from these independent forecasting bodies that look at the wider impact on GDP.
Thanks, Eleanor. Do you think we have time for more questions, or shall we be wrapping up?
I think we've probably got time for one more, at least.
Okay, good. So let me have a look. Maybe another one for you, Eleanor. What about the plan to levy large fees on Chinese container ships calling at US ports? Again,
a policy that's somewhat light on details yet, but with plenty of potential loopholes that we can see. From what the little we do know, we expect that any fees will be passed back on to cargo owners, and therefore we expect cargo owners to look for alternative routes into the US that avoid US ports. So perhaps some good news here for Canadian and Mexican ports, in particular those with intermodal links into the US. Whether that loophole will be closed with levies on goods via alternative ports, we don't know, and we don't know how. We also expect that transshipment hubs in proximity to the US market, so good news for Caribbean ports potentially, will also benefit, as it may be cheaper to transship into smaller vessels from fleets with less exposure to Chinese manufactured ships to make the direct calls into the market. That's probably going to be more on the Latin American trades though, as the cost of transshipment obviously on a mainline trade would be exceptionally high. And as I mentioned in the financial section, we absolutely see a risk of congestion at key US ports, as rather than calling at maybe 3 or 4 ports within the port range, we're probably going to see calls on the West Coast limited to 1 port in the US, so Los Angeles, Long Beach, and on the East Coast probably at most 2 ports, to cut down the level of fees, because it's on a per port call basis, not a per vessel visit to US waters. So we're probably going to see Oakland and Seattle and some of the smaller East Coast ports lose out, but the risk of congestion at these major gateways is going to rise, and we could in effect, depending on whether you're a shipper, a carrier or a port authority, whether that's good or bad news, we don't know yet, but storage fees may well be on the up in the US market again.
Thanks, Eleanor. Yeah, probably no more time.
Yeah. Quickly before we go then, how's Drewry's advisory team? I know you're very busy at the moment. How are you supporting clients given what feels like an unprecedented level of uncertainty in the market?
Yes. So yes, across the team, the Drewry Maritime Advisors team, we have years of shipping and port sector expertise to draw upon. And as you know, we interact with your team, the research team, and together try to advise our clients, particularly in these times of change. So 2025 comes full of structural changes. So on the one hand, we have the container shipping industry with all the liner alliances reshuffling. And on the other hand, we have the ports and terminal sector with this mega deal, the Hutchison MSC BlackRock mega deal. So this keeps us consultants very busy. And we are in fact currently advising a few clients on strategy and helping them understand and navigate the implications of these key changes for their organization. So we are assessing deep sea liner networks, explaining how the formation of Gemini and Premier and the dissolution of 2M has impacted a specific region or a specific business. And we are now also starting to advise clients on the impact of this growth in terminal affiliate, liner affiliated terminals, what impact this can have to some port businesses. So please do get in touch with me or with DMA, Drewry Maritime Advisors, if you need help in assessing these changes on your ports and terminals. If you're a port operator, a terminal operator, sorry, a port authority, a terminal operator, or if you are an investor, we are happy to help. So I think, we have run out of time. There's no time for more questions, and this will conclude today's webinar on Drewry's latest insight into the ports and terminal sector. We would like to thank you very much for your participation, and if you have any follow-up questions, please do not hesitate to contact us by email using the email address you can see on the screen. If you would like to view and listen to a recording of this webinar, we will be posting a link to this on our website later today. Thank you once again, and we look forward to your participation at future Drewry events. Thank you.
Thank you.
Bye.